Well, good morning. This is Rich Morrison, and this is my latest edition of the Thinking Cap. It is Monday, September 23rd as I'm recording this, and I wanted to visit with everyone a little bit about margin protection insurance for 2025. The deadline to purchase margin protection is a week from today, Monday, September 30th. That's also the deadline for winter wheat coverage as well. So I know a lot of people are busy in the field right now, and so I did want to take a minute at least to get some information out to you for you to at least consider if you're thinking about margin protection insurance for this coming year. I'll say this right off the bat. I don't think the decision is quite as easy as it's been for me the last couple of years. We've had some very high commodity prices the last 2 to 3 years, which has really improved margins on the farm and given us some tremendous opportunities to lock in some really strong margins for the coming year. That's not necessarily the case right now. We know that input costs have not gone down like commodity prices have. And so this makes this decision a little more tough, but still it's something we need to discuss. So with that, I do want to go through a few things, and some of this information I've shared with you already through some other means, but this is a snapshot from a Revenue IQ letter that I put out about 2.5 weeks ago. And I really think, number one, the decision about margin protection, first question you need to ask yourself is, do I see a need for more coverage than 85%? If I don't, then we don't even need to have the conversation. But I think for a lot of growers this year, as much as any, we're going to need something in addition to the 85 coverage to try to cover cost of production. So if your goal is to utilize your insurance program to cover your expenses, maybe even lock in a little bit of profitability, then I do think that the discussion about using 90 or 95% coverage does come into play. So if that answer is yes, then I do think you need to start talking, at least listening about margin protection insurance. Then the next question is, which product is better? We have margin protection insurance, which sets its prices right now. The deadline is coming up here next week. Or I can wait until spring and buy enhanced coverage option, which the deadline for that will be March 15th. So I put this in my Revenue IQ letter comparing the two products, and because I think that that's important. And so what are the differences? These are both 95% area-based triggers. Margin protection in the past, and I'll show you this in a minute, has had a better tendency to set its higher price in this August-September window, whereas ECO has had the trend of setting the higher price for soybeans in the month of February. So corn tends to be higher now, beans tend to be a little higher in February. One major factor this year is the premium support for enhanced coverage option, or ECO, is going to see a bump of 21% to 65%. We don't get that from margin protection. So in the past, MP has been slightly higher than ECO, partly because of the dollars of protection available. This year, it's going to be quite a bit higher. MP still has the 1.2 multiplier. That's not available for ECO. The other major point, and one of the reasons I really like margin protection insurance, is that it has a much larger degree of coverage. It's going to cover from 95% dollar-wise all the way down to where your individual policy would start to trigger. So let's say you buy an underlying 80% RP coverage in the spring. And many times, the way margin protection is calculated, you get a credit, and many times that 80% policy may be entirely covered by the credit. But the MP policy is going to cover from 95 down to wherever your individual policy would kick in a payment. So if your yields tend to be better than the county, at 80%, you may not even still get a payment, where MP is going to continue to pay all the way down below that level. We're going to see that here for 2024 in many areas. For ECO is a strict band of coverage. It's a 9% band from 95 to 86. You can calculate what that is worth before the year. So it's going to be very limited. This year, for example, we've got a lot of counties that ECO band is going to be worth $90 to $100 an acre. MP may end up paying $150 to $200 an acre, depending on your underlying coverage. MP is not connected to your APH. Your APH does come into play when you're calculating dollars of coverage for ECO, might make a $2, $3, $4 difference addition possibly if your APH is higher than the county average. Input costs are calculated in margin protection, where we don't have that with ECO. Both of these, I've always said, act like a put option. I'm buying 95% coverage, and certainly there's going to be areas this year that collect because of a drop in yield, but the biggest reason the last 2 years that we've seen payments have been because of the drop in the price. And both of these products protect against that. And so that's why I think this pricing period makes sense to understand which one tends to be better. So looking into some of the questions, again, this is from that same Revenue IQ letter. To me, this is the major question. If I've decided I need something additional to 85% coverage this year, then ask this question. If you think 2025 prices are high right now compared to where they're going to be in February, and you want more total dollars of coverage, then unless you're going to go to the market and sell grain, which most of us aren't, margin protection probably makes the most sense. So again, if you think prices are high compared to where they're going to be in February, and you want the policy that's going to give you the most dollars of coverage, MP makes the most sense. If you don't think prices are going to drop significantly between now and February, you still want 95% coverage, and you want to take advantage of the higher subsidy, then ECO might make the most sense this year. So to me, that's the biggest decision to make between these two products. And we'll hit on this again at the end. But why margin protection? Well, this is the mode, or this is where we're at right now in the markets. And you can see that, I've talked about this for a couple of years now, but we're in that similar pattern of what happened a decade ago when we came off of extreme high prices, when we saw demand cut, when we saw production increase, we saw stocks grow, and prices have continued to drop in order to try to search out some demand. And so September corn recently traded down to 360 and a half. It's pretty easy to forget now. We're looking at the December contract, and it's up to 411 and a half here this morning. So we're 50 cents off that September low. If you think there's a chance that we could take D's corn for 25, back down to these levels a year from now, then these higher coverage levels are going to make a little sense to us. And if you look at the history of corn prices, I think that this is kind of one of those things that probably makes margin protection look like a better alternative. But if you look at the August-September window, it's been the higher price 8 of the last 18 years. February's been the high 5 of the years. And then 5 of the years, it's been the fall price. Now, either if you buy margin protection or ECO, either one, you still get that harvest price. So if you want to add those 5 years, then margin protection, 13 out of 18 years, would have had, the high price included for crop insurance, and 10 of the years it would have been for ECO. The last several years, it's either been margin or the harvest price. And so we've come off of this pattern like we did in 13 and 14, where we've got high prices now. In 15, it was kind of a sideways pattern, slightly higher in February. Where are we going to be this coming year? I don't know. But if I'm concerned that we could be below 440, that we could continue to see that price drift, then maybe margin protection makes some sense. And so here's what our indemnity worksheet matrix looks like. And if you're an agent listening to this, I would encourage you to pull this up if you haven't. Download it, update the numbers, and utilize this tool, because it's a really good tool to be able to show you everything to do with a margin protection policy. But the base prices were all set here by September the 13th. You can see 440 corn, urea, DAP, potash, diesel, interest. Those are your variable input costs. Here's where the prices are trading today. If you go to the Agent Advantage website, they update this daily. We will set these final input prices in the month of April, with the exception of interest, which gets set in the fall. The corn price will be set next fall as well. As of today, there's not been much change in the overall expense side. So this negative $56 really represents my 5% deductible with a 95% policy. But the matrix then is going to show me 100 and some examples of price and yield. And so I ran this for Hamilton County, Iowa. It could be any county in the country. And the one thing I do have included here is this protection factor of 120%. And the way that comes into play is if let's say there's $1 loss in the area and margin, then you're going to get paid $1.20. But you can see here that if, Hamilton County comes in with an expected yield of 211.3 next year, I need to get my face out of the way here, but a price down at 410 is going to be paying back $20 an acre. And at 395, we're going to be at $58 an acre. And if we get back down to that September low that we've been at just recently, now you're talking 100 and some dollars an acre. And even with a better than expected county yield, you could be looking at some large payments. So if I'm nervous about price going down, I think that's the biggest reason I would jump on margin protection right now. If I'm nervous that this 440 level is still too high, that we're going to continue to see good crops, we're going to continue to see growth in stocks, and we're going to see prices drop, then margin protection makes the most sense. And if I skip it, then I don't have an insurance product between now and February. Well, we can talk about that off to the side, but it's February is when we set our ECO price and for revenue protection. And so this is our opportunity to have a subsidized coverage that's going to basically act like a put option between now and the month of February. Looking at soybeans, pretty similar chart for soybeans. We're still in that trend lower. You can see that we traded the August contract down to 936 and a quarter. Our low back in 2016 or 15 was all the way down to 844. And I've continued to say that I think beans are the worst looking balance sheet out there right now. If this South America crop with these added acres, if they were to raise a good crop again, look out for this bean market a year down the road, especially if U.S. acres don't drop. And so if you're nervous that bean price could fall, certainly this product makes sense. Now, historically, this August SEP window has not been the best window. However, it was in the years following the high price in 2012, and it was this past year in 2024. And if I'm fearful that prices are going to continue to be in that erosion mode, kind of like we saw in 15 and even out into 16, then maybe it still does make a little sense, especially with a subsidy behind this product this year. And so here's what our worksheet would look like for beans. This is in Pike County, Ohio. Again, it could be any county in the country. There's the input prices. The one noticeable difference here versus corn is that we don't have urea in soybeans. And so that makes the bean cost, variable cost, a lot smaller portion of this policy. And historically, these costs don't move a whole lot for beans. And so really beans boil down to more of a revenue type product at 95%. And so you can look down on the matrix and say, well, if we had 100% of our expected county yield next year, 975 beans, we're going to be triggered payment, or 980 or 990 or somewhere up in that neighborhood. And if you think that there's a chance we go back to the 2015 low at 844 or even below $9, certainly this might make some sense. And so again, those are the decisions you got a week to make. And this product, could end up being a good hedge or a good put option if I'm nervous that prices are going to fall between now and February, especially when our next chance would be to buy ECO. So these are a few of the other thoughts. I had this in my marketing report last week that MP does come with a 1.2 protection factor. That's a huge advantage in a loss year. It's going to be a huge advantage this year to those that took it. However, I can trim my cost back and reduce this. A lot of people are trimming it back maybe this year, considering go back to the 1.0 protection factor on corn. That makes probably an $8 to $10 difference in your premium, and you still get paid $1 for $1 loss. So that's something you might want to consider. MP, keep in mind it's a crop by crop, county by county decision. You can do it in one county, not another county, just as if you would market your crop. Maybe you don't do your whole crop at one time. You can do the same thing with margin protection. If you farm in two counties, maybe I do margin in one, maybe I wait to buy ECO in the other one. MP allows you to lock in the price today at 95%, which I think gives you some peace of mind for the next few months. If I'm nervous as heck about, if the size of this crop is big and this price continues to drift like it did a year ago, for example. We went through the month of October last year, and in November, December, January, February, prices kept going down. And we ended up 40 some cents lower in corn. We ended up $1.30, $1.40 lower on the bean price that was set in February. MP allows you to at least lock something in. And finally, the biggest advantage to margin protection, in my opinion, is the dollars of coverage from 95 down to wherever my individual indemnity would trigger. And so if I'm buying 80% RP, then I'm essentially getting 15% with margin protection. ECO is just a 9% band. I would have to add SCO or do something else to have some additional coverage with that. So this was from my, again, back to the Revenue IQ letter. I mentioned in here that a year ago, ECO worked out better than MP did because input prices went down. And the starting price a year back wasn't that much lower for ECO. This year, however, the margin protection price, as I mentioned a second ago, was a lot higher than the ECO price. So it's going to be a big advantage versus ECO. So here are some things that I consider doing right now. If I'm in the combine today, shelling corn, cutting beans, I'm thinking ahead to 2025. I could do nothing. I could number 2, forward sell some 25 crop. I doubt anybody's going to do that. Number 3, I could buy put options. I doubt anybody's doing that. Number 4 would be to buy margin protection insurance right now to take advantage of where the prices are, at least to lock in a floor. And number 5 would be to wait and buy other coverages in February and just hope that this market doesn't go down between then. So again, go back to these questions I asked. If you think this current price is high compared to where it's going to be in February, and you want the additional dollars of coverage from 95 down to your RP level, then MP makes the most sense. If I'm not afraid of the prices dropping significantly between now and February, I still can buy 95% at a cheaper premium with ECO at that point in time. So these are the really the points that I think you need to make the decision on. If you're considering MP coverage, then you've got a week to get that done. So with that, I thank you for listening to the latest edition of the Thinking Cap. If you've got questions, anything you want to ask, feel free to shoot me a note, and I'll be glad to try to help you out. So take care. We'll talk to you again very soon.